It's hard to overstate the importance of cost when building a client's portfolio. There's been research by Morningstar and Vanguard, for example, which has consistently shown that cost is the single most important predictor of future fund returns. Of course, a lot of investors, and indeed sadly a lot of advisors, still think that it's something to do with past performance, but that actually tells us very little about future performance. These figures, these percentage figures, can seem tiny. You know, we're talking about 1% or 1.5% or whatever else. But when you add all those figures together and compound it, this is the critical point, compounded over many years of investing, it can make a huge dent in the client's net returns. I would never say never put a client's money in an actively managed fund. My opinion is that you shouldn't. I appreciate that some advisors might have an alternative view. The one thing I would say is that if you do go for an active fund, you should go for one with a low cost, ideally the lowest possible cost. The question you should ask yourself though is, can you really identify the winners in advance? The peer-reviewed, time-tested academic research shows that over the long term, only about 1% of funds outperform the market over the long term on a risk and cost-adjusted basis. Can you pick that one fund out of 100 that's going to win? It's hard. There is academic evidence to show that by tilting the portfolio to particular risk premia, you can outperform the market. Famously, of course, Kenneth French and Eugene Farmer have shown that by tilting to size, value, profitability and momentum, for instance, you can beat the market. But just because these premia have worked in the past, it's no guarantee that they will outperform in the future. Outperformance tends to come in short, random bursts, and the bottom line is that it's slightly more risky. You are exposing the client to more risk by putting them in these funds. The biggest advantage of low-cost index funds is simply the cost. You know, they are very much cheaper, and I mean very much cheaper than actively managed funds. When you take into account transaction costs and other hidden fees and charges and so on, it's not unusual for an active fund to cost 10 times more than a low-cost index fund. And it's like, you know, paying £12.50 for a litre of fuel when you fill up, or buying a pint of milk for £6.50. It really is a no-brainer in terms of cost. Another really big advantage is simplicity. It's really important as an advisor that you ensure that your client is in a strategy that they can stick with. And if it's simple, they're far more likely to stick with it. And finally, index funds offer ultimate diversification. Jack Bogle, the indexing pioneer, had this phrase. He said, indexing is like buying the whole haystack. It's not looking for a needle. It's very, very hard to find that needle. If you buy the whole haystack, you are very diversified with all the risk and return benefits that brings.